Recently, I was in the post office. So in the UK, most people that send parcels and letters, actually not most people, but a lot of people will go to the Royal Mail post office. And there was a person next to me, and we got chatting about. It was really triggered by the length of the queue that we were stood in. This person said to me, these queues never used to be like this. And that is my experience also over the last few years. I know that, for example, in central London, post offices that were, that were used every day by many people, they have closed, forcing the users of those post offices to go to another post office that's the next closest to them. And I know this caused a lot of trouble for, in particular, elderly people. Now, older people are less likely to be bothered about doing everything on their smartphone, and apparently lots of people would pay their bills and receive some cash via the post office. And lots of post offices in the UK also sell provisions, so they are a mini supermarket and a post office. So they have great utility in society. But because of changes and because of how the Royal Mail is managed, decisions were made that they wanted to save some operating cost and to rationalise and to remove some post offices. Now, I imagine that they claimed that the post offices that they removed were less needed, were less used, and were not profitable. And I find that very hard to believe, because over the last 10 years and 20 years, whenever I've been into a post office, if I'm honest, it's always had people the customers in there. And to varying degrees, that the queue for the service has been, a person or three people. You might have walked in and there might have been no one there, but you can bet your bottom dollar by the time you walked out, there would be, somebody else there. And what this means is that the utilization of post offices, was and has been, very good. I don't think people mind waiting in line for 30 seconds or even a couple of minutes. But the queue that I saw today, that I was in today, was definitely more than a few minutes, and many people. It wasn't just me and the person I stood next to commenting about it. Other people were, and also I detected that the staff were a little perturbed, really. And they were probably frustrated themselves because there was a large queue forming, and they probably wanted to serve customers and get on with their job. But it made me think, recently I had done a video titled Zeitgeist, which it was really, me chatting away about Sign of the Times. And once again, today with this person, I found myself saying it is a sign of the times. Number one, technology combined with the executive style of a large company executive, the style of management that we have today. And the conversation that we were having was around what is best for society, because many of us can assume that all of a sudden removing banks and post offices for people that use those utilities, those organisations, tends to be older people, because also this person added that they had noticed that lots of banks have closed also, because of technology, because of smartphones and online banking, that sort of thing. And so again, I was focused on the impact of technology and business style of management. Now, I think the impact of technology, online banking, using your smartphone and your home computer to deal with your sending letters, sending your post. Now many couriers will come and collect the post from your house, and I suppose that's very good. But what it did do is lead me to a brief conversation and discussion with this person about management style. Now, often I've met investors that, in conversation with them, it will prevail that they would like return on their money, and they would like it sooner rather than later. And they don't want 10% back. They're looking for 20% and 30% back. Now, at that point, I say, 30% profit is a lot of pressure on an investment fund. And their response has been no. There are investment funds that offer much more than that. And at this point, I haven't mentioned the time frame. Recently, I was chatting to an investor, and they indicated that not only did they want 30% return, they wanted that return, the indication was they wanted that return in less than 12 months. And I pointed out to them what their expectations mean to the executives of the business investment fund or the business operation that they are investing in. Demanding from that investment 30% return in 12 months is almost ludicrous. It's very, very difficult. Just to offer some analogies very quickly, the car industry runs on profit margins between 1.5% and 3%. So if you're manufacturing motor cars, that's the sort of profit margin that you are looking at. The restaurant food industry today, in my experience, is probably looking at about a 10% profit margin, which for that type of business operation, that's nothing. It's not enough. Perhaps some are enjoying 30% profit margins. Maybe one or two are higher than that, but I would say that a lot of food and restaurants type of business, that 10% profit margin target is very hard work, especially in the economic climate and business conditions that we're in right now. But I went back to this investor and I thought to myself, hold on, you are talking, you're indicating to me that you have access to this money, you're wanting to buy something with it, you're wanting to invest it somewhere, and you absolutely require 30% return within 12 months. And you don't seem to have any thought about the impact of that investment, the pressure that it puts the business operation on, or the pressure it puts another fund manager on. These days, making profit from money, if you're using the financial market or you're using other investment vehicles, making profit is hard, because essentially that profit has to come from the value build proposition inside something else. If it's a company, it means that that company has to have large profit margins. And as I've said, the motor car industry operating on 1.5% and 3% profit margins, the restaurant food industry is around 10% profit margins. These business operations are run very well, and they are shaving off cost like you've never seen, and they are very price competitive, and they can only squeeze out 10% and less than that. But yet this investor that I spoke to me like, I expect 30% within 12 months, like clicking my fingers. And I thought to myself, I'm coming to the thought here that the problem is you and your expectation, and I imagine that expectation is coming from greed within you. You simply want your bonus based on the investment size that you are dealing with and the potential profit that you are earning. Now, I wasn't that happy with this individual because I thought to myself, you know, in this conversation, you have not mentioned to me once you want to invest in a business that you like, a product that you support, employment. You haven't mentioned once that you want to support that activity. And if I had have prompted them to talk about that, they will have probably said, oh, and of course, I am promoting, you know, local economy. I am promoting employment and a great product. They would have probably said that, but it would have been a reaction to my prompt. I got the strong impression that they were greedy and they were in a position of power, and they were simply portraying a behavioral style that their colleagues display, and they're displaying a mood of the investment industry. Because that's not the first time I've come across that. I've come across that many times, and I haven't even spoken about some of the more worse examples. So I've spoken to investors that perhaps have a little more money. I'm going to offer you some numbers now because it's interesting. Small businesses and individuals that are perhaps around the $30 million mark, and they're wanting to make investments around the several $1 million to $10 million mark. And for some reason, they are literally conducting their business as though they are going to find a business operation or an investment or an angel investment with an investment with a build profile, with a value build profile in excess of 100% over very short periods of time, even 200%, 300%, and they were looking for that. Now, if you're an angel investor, it's a little bit different because angel investors often expect a lot of their investments to fail. So you know, it's all cash burn, which is understood. And so, for example, an angel investor or a venture capitalist, a capital might invest into 10 companies. And at the back of their mind, they will be thinking that 9 of those businesses will not work. So all their investment is burnt away. But they are expecting that one of them, about 10%, is going to work. And the value build proposition is very high, and the profit made from that one business punt is greater than the loss of the 9 others. Now, you know, that's sort of understood, but once again, it's pointing to, gosh, what are these businesses that have that value build proposition that's so high? And of course, I think many people will know that the technology environment, fintech and technology startups do attract these huge value growths over a short period of time. And that is true, but you have to look at the marketplace, and you've got to understand it very well, because you have to select the technology that you think is going to be good at what it claims to do, and also people are going to want it. And so there's a lot of skill involved there, and I suppose, you know, that's fine if that's the case. But I'm talking about organizations like institutional investors, private investment funds, that sort of thing, where there sometimes is this feeling that they expect that everyone that they invest in, every business they invest in, is going to be a hit, is going to be successful, and they're going to 3 times, 300% in return over the space of 12 years. And I think it's just impossible unless the game is rigged, unless they are purchasing an investment proposition at a very discounted rate, understanding that they know that the real market value is going to be much higher within that 12 months. I suppose that's a different conversation, because, you know, that's called a rigged playing table. And again, you know, it's the privileged few that always benefit. But I was wanting to come round and link that to the conversation I had in the post office, and to make the point about technology and executive investor requirements on companies that put this pressure on business operations, and you end up alienating your customers or the general public at large. And I believe that's what's happened with the Royal Mail and the Post Office. Now, I'm more than happy to be furnished with more information that tells me otherwise. And maybe it is, a further sign of the times. But I think a lot of it is down to the mood music in the executive area around these large companies, and also investor greed that has been with us for far too long now. And what it does, it kills the investment that they invest in, because they put too much pressure on the executives of that investment fund or that business. And over time, that additional pressure can have a negative impact. I have met investors that have said to the startup company that they've been invested in, or the investment vehicle that they've invested in, and they have said, "Hey, I am just happy to get my money back. What I like about this investment is I like the people, I like the product, and I like the fact that I'm able to benefit these people with the money that I have. And if I get the money back, I am happy." Now, for me, that investor rocks, and that investor is the investor that you want close to you, and the person that you should be hitching yourself to in business, because people buy from people, people like people, and an investor with that mindset is probably going to be very good at choosing the investment that he would probably invest in anyway. And that investment is more likely to be successful, and is more likely to produce these 300 times, 400 times, these massive value build propositions. And my point really is, once again, a zeitgeist. We're in an odd time. Lots of executives have got this industry wrong. Lots of executives are creating problems. They are the problem themselves. And we all need to focus once again on people, processes, and society. That's what we should be focused on much more, and that should always be weighed against profit. And for many investment firms, for many private equity houses, they don't give a damn about people. All they give a damn about is the short-term profits that are available to them because of their position of power. And I think it's wrong, and we want this on the table, and it needs to be discussed. Anyway, after that little rant, I hope everybody is well, and I hope to speak to you again soon.